Hi class, this video is going to introduce you to how to create income statements for trading businesses. So this is chapter 20 of the Macmillan textbook, and it's going to slightly differ to what we did in income statements in unit 1. So this video is for unit 2 income statements because it's for trading businesses. Remember, income statements in unit 1 were service businesses. What do I hope you get out of this video? I hope there is some revision in terms of what an income statement looks like and how we identify revenue and expenses and profit. But then you also understand the small but important differences of how an income statement looks for a trading business. A future video, which will be created in a couple of days, will explain how to analyze and evaluate the business financial performance in terms of its profitability. So what do you remember from unit 1 in terms of an income statement? Pause the video. Can you remember income statements? I hope that you remember that it's really important to distinguish cash, which we record in journals and statements of receipts and payments and cash flow statements, and profit, which is what we record in an income statement. And it is, as we said, it is the income statement that focuses on profit. So every time you hear of an income statement, we're going to be having a record that reports profit. And I hope that you understand remember the definition of profit under the accrual assumption, which is an important accounting assumption, is profit equals revenue earned in the period less expenses incurred. So we're going to identify all the revenue that's occurred in that period, minus all the expenses incurred, and that will get us to our profit. And we're going to report it in an income statement that looks something like this. And this is what we did in unit 1. We identified all the revenues, sales, and added them up, in this case 4,100, and then subtracted all of the expenses. And these were 2,950. So the net profit being revenue earned, 4,100, minus expenses incurred, 2,950, equals $1,150. It gets a bit more complicated in unit 2. We're going to go through this soon because we've learnt there's different types of profit. Gross profit, adjusted gross profit, and there is inventory involved with trading businesses, which isn't necessarily involved in a service business. But let's go through the test of how we identify revenue because it's been a while. What is the test for revenue? You must tick off 3 things. All 3 must be ticked off. It must be an inflow of an economic benefit. So for example, an inflow of cash, but not all inflows of cash are revenue, because it must also result in an increase in assets. So it must be due to, for example, a sale is an inflow of an economic benefit that increases an asset, either cash or accounts receivable, that importantly results in an increase in owner's equity. So we're not swapping assets or anything like this. This is going to improve the business's worth. It can't also be capital. You are not going to report your capital contributions as revenue in your income statement. So if we remember that all 3 of these must be ticked off, so we tick them all off, 1, 2, 3. If we can tick all of these 3 off, we know it's revenue, we know it goes in the income statement. And as you do more of these, you'll just remember the headings that are revenue, but that's your test. Expenses also have 3 things that must be ticked off. Expenses result in an outflow or consumption of economic benefit because this is, if we think about it, not necessarily a bad thing, but it is definitely reducing profit, so it's an outflow. This outflow must result in a decrease in assets. So if we have to pay for our telephone bill, which is an expense, the outflow is cash, and this is decreasing our assets. That leads to a decrease in owner's equity. Decreases how much it's worth. It's not resulting in an increase in another asset or anything like that. it can only result in a decrease in owner's equity. If we tick off all of these three, we have an expense, and it goes in our income statement. And again, you'll get really good at identifying expenses. As you're practicing for the first few, make a glossary. What are some common expenses? Electricity, cost of sales, wages, those sorts of things. So what is new with our income statement for Unit 2? It is reporting income statements for trading businesses. Trading businesses have inventory that they purchase and then sell. And there's more aspects to that. And also we've just got better at accounting now that we're in Unit 2. The major difference is, as we discuss, is that we're talking about trading businesses. Trading businesses have inventory, so we have an additional expense calculation called cost of goods sold, and we've worked out now how to calculate gross profit. And this is not as relevant for service firms because they do not sell goods, so they don't have a cost of goods sold because they haven't purchased it off someone else. And what is gross profit? This thing that we've become experts at calculating. It is sales revenue, so all the sales we identify, less the cost of goods sold. All of the costs that have got it into the condition and location ready for sale. And now our income statement is going to look like this. And you can see it's more complicated. Revenue could be two different types, cash and credit. And our revenue is $205,000. We're then going to reduce that by a thing called sales returns of $5,000, so our total revenue is $200,000. We have a cost of sales of $90,000, which is an expense, that results in a gross profit of $110,000. Because we have inventory, we might have an inventory loss or gain. In this case, we have an inventory loss, which is an expense, so we less it of $5,000 to get our adjusted gross profit. So if we pause there, from revenue of $205,000, we have resulted in adjusted gross profit of $105,000. Then we start to less that by all our other expenses that aren't involved with getting it into the condition and location ready for sale. Wages, office expenses and insurance of $70,000. So then and only then can we calculate net profit of $35,000. So we're still identifying revenue and expenses, but we're now going to have to think about what subheading does it go into. So this is really the flow chart that I want you to think of. Can I identify my sales? And were there any sales returns? Because then I will get my net sales. Net sales minus my cost of sales, or cost of goods sold, slightly different, but that's what we're looking at, equals my gross profit. Gross profit will then either be subtracted via an inventory loss, or it could be plussed for an inventory gain, and that gets our adjusted gross profit. Adjusted gross profit then subtracts all other expenses to get our net profit. So now we've definitely got some new terminology to remember, and this is really the glossary or summary notes to remember. Sales are still sales. These are the main source of revenue for a trading business. Remembering these could be cash and credit, and we find them from our journals, our cash and credit sales journals. Sales return are returns of some of its sales. So the person that bought our goods might not be happy with them, so understandably they return them, and this is going to be what we call a negative revenue item. We haven't earned that revenue if it's been returned to us, so it is deducted from total sales to get net sales. So net sales is the total amount of sales for the period, less any sales returns. If we had $100,000 of sales, but $7,000 was returned, our net sales is $93,000. We then have cost of sales, which is the cost price of all our inventory sold during the period. And then we can find that if we have an inventory card in the out column, excluding all the memos. So we're going to total up all the out column, excluding memos. This could also involve cost of goods sold, which is another heading, and we might have other expenses here like cartage in as well. Gross profit is then what we determine by deducting cost of sales from our net sales. And then we will look to see if there's an adjusted gross profit, if there is any inventory losses or gains. So we'll get that from our inventory card and physical stock take, all the information. And then and only then do we get our net profit. And if we understand this and can identify revenue and expenses, then we can calculate net profit, and net profit is going to impact our balance sheet. So we've now moved on to accurately calculated our net profit. How does that impact our business worth and our balance sheet? The thing to remember is if we have a net profit, that is going to be a good thing for the business. Net profit increases owner's equity, and owner's equity is reported in the balance sheet. So this is further evidenced by if we think about the twofold effect where our accounting equation must always balance. Revenue represents an inflow of resources that increase assets, usually accounts receivable or cash, hence they must also increase our owner's equity. Expenses reduce our assets often and hence reduce our owner's equity. So if we understand this, we can then be an expert at reporting an income statement and getting our net profit. And then hopefully we'll become an expert at putting that into our balance sheet as well. So if we have a profit and the numbers are different here, in our owner's equity section, we're going to plus our net profit to our existing to increase our business worth. You might remember we don't report drawings as an expense. They're still important and they reduce our owner's equity. A net loss is still going to impact our owner's equity, but negatively. So it's going to reduce our owner's equity. Our capital is reduced by $10,090 because of our owner's equity. And in summary, these are the things that we want you to become experts in Unit 2 income statements. Still identifying revenue expenses, but classifying them as where they go in the income statement to accurately report not just net profit, but gross profit, adjusted gross profit as well. And using this, we will be able to evaluate a business's profitability more effectively and with more detail, which will allow us to make better decisions as accountants and business owners.